The tide continued to shift in favor of home buyers in the Greater Toronto Area last month amid higher borrowing costs. How was the real estate market in May, and how do we expect real estate market to trend in the near future with overnight interest rates at 1.5% now and expected to hit 3% in the near future as indicated by Bank of Canada? That is what we are going to discuss in this video, so stay tuned. Hello, this is Sonia, your local realtor with Remax Realty Specialist. Welcome to my channel where we love talking about real estate and all things in and about Greater Toronto Area, and we would love to take you along the ride. So hit that subscribe button and the little bell icon so you get notified every time there is a new video uploaded. Will there be dip in the prices? Definitely yes. Is it going to be 50%? No. Is it going to be 15%, 20%, or maybe even 25%? Probably yes. We don't see a catastrophic bursting of this balloon that we have been living in because Toronto and the Greater Toronto Area for Canada is a very important economic center. People will continue to come to Toronto wanting to live in Toronto or Greater Toronto Area. The people most likely to get into trouble will be investors who bought units to flip or whose mortgage payments are higher than what they can expect to collect in rent. As interest rates rise, while investors come to account for about a fifth of the market in Canada through last year, any units they are forced to sell will ultimately find buyers or renters amid record immigration levels. Softening market conditions finally caught up to the city of Toronto, which had shown price resilience compared to the 905 market in the past few months. Sales fell 11.4% from April with 2,679 transactions, resulting in flat month-over-month growth of minus 0.74% to $1,233,748. Meanwhile, the 905 markets continue to see larger losses. Prices fell 4.8% month over month to an average of $1,243,070, down more than $60,000, while sales dipped 7.6% with 4,604 transactions. Home sales in the Greater Toronto Area sank 38.8% in May compared to a year earlier, as 7,283 properties changed hands. It also represented a 9% decline from April. It is the second month in a row where sales were down on a monthly and annual basis. All property types, ranging from detached home to townhouse to condos, posted significant double-digit sales decline compared to May 2021. The data showed active listings jumped 26% year over year in May, while the number of newly listed homes was essentially flat. The shifting dynamics of the market comes as the Bank of Canada aggressively raises its benchmark interest rate. There is now a psychological aspect where potential buyers are waiting for a bottom in price. This will likely continue through the summer. However, as home buyers adjust to higher borrowing costs, housing demands will be supported by extremely low unemployment, high job vacancies, rising incomes, and record immigrations. The Bank of Canada hiked the target for its overnight rate by 0.5% on June 1st to 1.5%. Bank of Canada has indicated the central bank's key lending rate could rise above 3% to tamp down inflation. While buyers wielding more negotiation powers, the average selling price of a home fell roughly 3% to $1,212,806, still up by 9.4% year over year, but sliding 2.6% below April. The average home also now costs $121,738 less than it did in the February price peak, representing a 9.1% drop. This is the third straight month where the average selling prices have declined after hitting a record level of $1,334,544 in February of 2022. Overall, the market finds itself in a better balance as new supply comes online with overall healthier inventory levels. A total of 18,593 properties were newly listed in May, with the month ending with 12,247 available for sale, nearly triple the record low of 4,140 seen in January of 2022. That led to an easing of the sales to new listing ratio, the measure of buyer competition in the marketplace, to 65.1%, down from 68% in April. While still indicating sellers' market conditions, that is softened considerably from 72.9% at the start of the year. However, conditions remain tight enough to push the overall cost of housing higher, with MLS Home Price Index benchmark up by 23.9% annually. The sharp rising cost of borrowing has trimmed buyers' budget and also has them second guessing their timings. The shorter term impact of high interest rates will not be with us forever. Supply remains the long term challenge. Thanks for watching, and don't forget to join me next week. Until then, stay happy and stay safe.